Afternoon to you both. David, you must be a little embarrassed. You were so bullish for so long.
one divided by T.
Talk us through, David, the amount of data we've seen this week and whether you need to see it confirmed now by services and jobs on Friday to really confirm the bearish outlook you've had for so long.
Well, here's the problem, Wilf, is that by the time you wait for the confirmation as an investor, your head's been sliced off. So the bottom line is that for all the talk about what a low share of manufacturing is of the economy, it reminds me of all the pundits coming on your show 12 years ago telling you what a low share housing is of the overall economy, without talking about all the powerful knock-on effects that housing and now manufacturing has on the overall economy. So it starts with the goods-producing sector. Then with a lag, it hits the service-producing sector. The reason why services are so slow to move down is because social services and education, healthcare, are not really cyclical. What moves first when you're heading into a recession is the economic sensitive sectors, and they're behaving classically as they typically do ahead of an economic downturn, and it's not different this time around. And by the way, it's not just the ISM, breaking below 48. Look at the transports to utilities relative strength index. It's broken down. It's slumped more than 30%. Coming off an inverted yield curve, the small caps are now within 4 percentage points of an official bear market. So, it's not just about the economic data. There are signposts in the fixed income and the equity market telling you that the economy is going to be slowing down even further from where it is right now.
Tom Lee, do you agree?
Yeah, I agree with most of what David's saying in terms of, I think we're seeing visible weakness. The weakness is born out of that downturn in oil we've had. The trade war, I think that's really hurt inventories and the business cycle. And we had Fed tightening last year. So I think that these, cumulative effects are definitely, a drag on not only manufacturing, but, of course, investor sentiment. I probably don't agree, where we're going to sort of break with David is the idea that this downturn is the start of a cyclical, recessionary dynamic. And I think instead it's actually just a correction.
So Tom, where are you in terms of your S&P 500 forecasts for the next 6 to 12 months?
Well, I think that this sloppiness has been really sort of communicated by the bond market for some time. We've written since the start of this year that the ISM would likely break below 50 because of what the 1030 yield curve was telling us, and it should bottom in September, October. So it sort of followed the course that we've expected. But I think now we're going to start to see the benefit of Fed easing. There's been a huge inventory correction. On top of that, from a market position, as you know, the put-call ratio has gone wonky today. That's usually a sign of a bottom. The daily relative strength is about to touch 30, and that's a tactical signal. Most of our clients are sitting on cash or really bearish. So, to us, the most unexpected thing and the thing that we think is most probable, therefore, is a big rally into year-end. And I think we're still going to break 31.25 before the end of the year.
David, the last time we saw a contraction in manufacturing data and a so-called industrial recession was back in, 2015 into 2016. It didn't bleed over into the services and consumer side of the economy. Why does this feel different to you?
We are in a totally different bog of uncertainty right now. I mean, in 2016, were we in the middle of a global trade war? The answer is no. In 2016, the Fed at that point had only raised rates once. Go back to 2016 and look at the shape of the yield curve. It was steep. And look at the shape of the yield curve today. It's flat. I'm continuously amazed at people that dismiss the yield curve cycle in, cycle out. And it's not necessarily about whether it's inverted. The shape is flat as a pancake, and it's telling you that growth is going to be slow. It's interesting that nobody ever has a problem with the yield curve when it's steep. It's a wonderful indicator. Only when it's flat do people question its veracity. So you have a different shape to what the bond market is telling you. We're in a much different bog of uncertainty related to trade. And coming into 2016, if you remember, we're heading into the election. Donald Trump got elected. We had a sweep by the Republicans and tax cuts coming our way. What's happening right now that nobody's talking about is this impeachment proceeding and this Ukraine file. It's not really what it's doing to Donald Trump. It's what it's doing to Joe Biden and then what it's doing to Elizabeth Warren's prospects. This is, I think, what people are looking at behind the scenes is the rising prospect that we could see a Democratic sweep in November of next year. And with capital gains taxes, dividend taxes, wealth taxes, I mean, we could see a radical shift in fiscal policy that we've never seen before on top of the trade uncertainty. So I would just ask, I would ask Tom, who's a friend of mine, like, who is going to be committing capital to the economy in this bog of fiscal and trade uncertainty? So what happens here is that you start cutting your capital spending and spending intentions as a corporation, which, by the way, is in the data. And then with a lag, you start seeing it in hiring intentions and employment, and that's when it starts hitting the consumer. That'll be the story a quarter or two out, but I see it in the tea leaves.
Tom, your response?
I think David's nailed it on the head. The biggest risk to this market would probably be a shift in the White House. I think investors would be pretty nervous about what it would mean to have a Democratic president. And so, yes, I think in a way it's kind of circular. I think if the market holds up, I think Trump stands re-election. But if the market tanks, it raises the prospects that David just mentioned.
David, one quick final question. I just want to ask you what you thought the impact of the extra tariffs on the EU might have to Eurozone growth, and whether that can affect the US in the short term.
Yeah, absolutely. And then on top of all that, the stepped-up Brexit uncertainty. And we already know that Germany, which is the engine of the entire continent, is pretty well either in a recession or on the precipice thereof. And there's going to be knock-on effects. The one thing we learned from the last cycle is that no country, maybe outside of Albania, operates in a vacuum. So yes, when you look at what Germany means for the entire EU, and the EU as an economic unit is actually bigger than the United States. The reverberations back again towards the export sector, and then the knock-on effects throughout the economy are going to be relatively powerful. There's just lag separating this forecast right now from what's going to be happening by the opening months of next year. So I do think what's happening in Europe is very important. I think at the same time, all these things are keeping the U.S. dollar sky high, which is an added tourniquet on the U.S. manufacturing sector on top of everything else that's going on right now.